Hey guys, welcome back to the Mark Loeffler Experience. Guys, today I got the great debate. We're going to do the ROI versus ROE. Now guys, I know already you're thinking like, what the heck is Mark talking about? I know what ROI is. Well, I mean, some of you do, some of you don't. What is ROE? So ROI is return on investment. I mean, I've talked about it. You know, that's my percentage return on investment. On my initial investment, that's my return. And most people do that. And that's what most people calculate their returns at. Whereas, guys, I'm going to share with you, I'm an ROE guy. Comment down below if you're an ROI or ROE person after this. So return on investment, we've gone through it. I put down $100,000 on a property. I'm making $20,000 a year in cash flow, mortgage pay down, and increased value, or dividend and stock value, or whatever that is. I make 20% on my $100,000. That's my return on investment. What happens when you invest in real estate and you add value? And I mean, Paul Lasanti was talking about this the other day. He wondered about when the best time to refinance is. And this goes to ROE. ROE is return on equity. If I have $1 million sitting at a property, and let's use this for instance. I bought a property in Toronto, 16 years ago, a long time ago. My wife and I, and we bought that for $284,000. It's a duplex in Toronto. I mean, I don't even know what it's worth right now. 1.4. 16 years, I would have paid a lot of that mortgage down. If I'm sitting there on that much equity in the property, what's it doing? What's my return on the equity? So maybe I'm making cash flow $500,000, $1,000 a month. Yet if I'm making $1,000 a month, what's my return on $1 million in equity? What could I do with that $1 million? Being a savvy investor, smart investor, I've educated myself. What could I go do, and where could I go invest that money to go get a return? Could I make a greater return either A, by selling the property, or B, by refinancing that at low interest rates, hopefully, and taking that money to invest somewhere else? I'm an equity investor. So again, what that means is I'm always looking at my return on equity. I guess it's because I'm still in growth mode. I'm still in net worth growth mode. I haven't got to the point where it's like, you know what? I'm comfortable with the return on equity of 3, 4, 5%. I hope to get to that point where I'm sitting there looking, saying, you know what? We don't need to refinance those apartment buildings. We'll just roll that into the new mortgage at, like my buddy Mike Rocco there, at 1.8% new mortgage, and we'll just cash flow it. That's fine. We don't. Why pull out the equity? And there's a lot of people out there that do this. Yet I've always been an equity investor. I always come back and I look at it and say, okay, how much money do I have sitting there? Paul, to your point, when do you sell versus when do you refinance? I always prefer refinancing because I figure if I sell, and guys, in the States, this is a little bit different, right? Because you can do a 1031 exchange. We can't do that here. I have $1 million gain on the property. Because I live in Canada, our capital gains rate is right around 25% if I'm in the highest tax bracket. Let's just run 25%. So I make $1 million gain. I have 25, so I pay 25%. So I get $750,000 in cash. Now I have to go ahead and take that $750,000 and I gotta make $250,000 just to break even on the taxes. Now I know in the States, obviously you guys have a 1031 exchange and you can keep tax deferring as you roll up into other properties. They did talk about that here way back when with Stephen Harper. That was one of their campaign promises that never came to fruition because they got a minority government. Guys, maybe it's some stroke of luck that happens here. And it's why a lot of people don't sell ever, because they look at that and they say, the tax bill. Why would I sell? I can just, again, refinance at low rates. So that's my refinance versus sell. And when do you refinance is, guys, when it makes sense to go ahead and take the money out of the property that you can go ahead and reinvest that at a higher return than you're getting currently. So if my return on equity is 5% a year and I can go and invest that and make 20, well, I'm accelerating my wealth that much faster. Cash flow from Rich Dad Poor Dad, it's about once you get out of the rat race, so once your passive income is greater than your expenses, which should be everybody's goal. In the last video I talked about Tony Robbins, I couldn't remember the book name. It's Tony Robbins' Money Mastering the Game. And he talks about different levels of financial freedom. So number one level of financial freedom is your passive income is greater than your basic expenses. You can basically live, I mean, it's not a great life, like you're paying your rent or mortgage, your car, your groceries. Basics, just your basics. Number two is basically living the lifestyle you're living now, whatever you're doing, whether it's trips and, you know, going out, restaurants, that type of stuff, right? Number three is what's the big dream? That was Tony Robbins' Mastering Game. Well, let's go back to cash flow the game. So cash flow the game, once you get out of the rat race, passive income is greater than your expenses. Well, now it accelerates. So once you get out of the rat race and you go on, it's called the fast track, your wealth accelerates quicker because number one, you probably have some equity that you can go ahead and use and invest. Number two, so once your passive income is greater than your expenses, you're out there and it just builds faster and faster and faster. So why do the wealthy get wealthier? Well, because they're not out there spending all their money. I have, you know, $10,000 a month passive income coming in and my basic expenses are $5,000. Well, I'm not just going to go spend that extra $5,000. That's going to get reinvested. So as long as I'm not spending the nut, I'm not spending that basic of my passive income, well, it's just going to keep accelerating over time. And if I'm a decent investor, again, like 8, 10, 12% per year return, as we talked about last video in the rule of 72, you're just revolving that money. And it's just continuing to pile up and pile up and pile up. So this is why I always talk about ROE versus ROI. So guys, definitely thanks for watching. Like and subscribe down below. Smash that like button for the YouTube algorithm. Comment. Let me know if you're an ROI person or an ROE person. And any other topics you'd like me to cover, I'm happy to do it. See you guys next time.